Before we get started, I want to show you something important. This is a warning about a mistake that could be costing you thousands of dollars every single year. The W4V error draining seniors of $3,600 annually, and one simple form is all it takes to fix it. There is a single document that millions of American seniors completed one time, usually during the same week they signed up for Social Security, and have never revisited since. That document is quietly instructing the federal government to remove hundreds of dollars from their Social Security payment every single month. Not because they owe that money, not because any law requires it, but because they checked a box years ago out of habit or caution, and nobody ever told them they could change it. That document is called the W4V, and for the average senior who filled it out without fully understanding what it does, it is costing them between $2,400 and $3,600 every single year. Money that leaves their Social Security check before it ever reaches their bank account, sits with the federal government for up to 12 months, earning zero interest, and eventually returns as a tax refund that most people treat like a bonus rather than recognizing it as their own money returned late. That cycle repeats automatically every year until someone explains how to stop it. This video explains exactly how to stop it. If this is your first time on this channel, subscribe right now. Professor Kyle Pomerleau publishes new videos every week covering the exact tax rules, Social Security regulations, and government programs that affect seniors and retirees. Free, plain English, nothing to sell. Hit subscribe so you never miss a video that could put real money back in your pocket. Before going further, I need to address two groups of people who are already questioning whether this applies to them because both groups are about to make a costly mistake. The first group is the senior who believes their Social Security withholding is correct because a tax professional set it up. They assume a qualified expert reviewed their situation and the withholding reflects what they actually owe. For some of you, that is true. For many of you, it is not. The W4V is completed at the time of Social Security enrollment, which is often years before retirement is complete, before other income sources are established, and before the full income picture is clear. A withholding instruction set at age 62, based on projected income, is frequently wrong by age 68, based on actual income. The professional who prepares your annual return sees the result of the withholding, but may have never examined the W4V itself. The second group is the senior who believes Social Security is always fully taxable, and therefore the withholding is unavoidable. That belief is incorrect. Whether your Social Security is taxable at all, and how much of it is taxable, depends on a specific calculation involving your total income from all sources. For a large number of seniors watching this right now, the correct federal tax on their Social Security is significantly lower than what is currently being withheld. For some, the correct amount is zero. The withholding continues regardless because the W4V has never been updated to reflect the actual liability. I'm going to walk through both situations and give both groups the exact steps to fix it with one form. Stay with me. So why does this problem exist, and why does it persist year after year? The Social Security Administration does not review your W4V against your current financial situation. Once the instruction is on file, it is executed automatically every single month without any examination of whether the amount still reflects your real tax obligation. The SSA processes the withholding you requested. It does not tell you that your withholding is higher than necessary. The IRS receives the withheld money and holds it until you file your return. If your actual liability is lower than what was withheld, the difference comes back as a refund. From the IRS perspective, the system worked correctly. You overpaid during the year and received a refund at filing. What the IRS does not do is notify you that the overpayment was unnecessary, or that a single updated form could eliminate it going forward. The SSA processes W4V instructions for over 40 million beneficiaries. A meaningful percentage of those instructions were set years or decades ago, under financial circumstances that no longer exist. Nobody at the SSA is reviewing those instructions against current tax law or current income levels. The instruction on file is the instruction that gets executed every month, every year, until you change it. The entire burden of correcting this falls on the beneficiary, and most beneficiaries do not know that burden exists. My name is Professor Kyle Pomerleau. I have spent decades studying federal tax law and its practical application to the financial lives of American retirees. The situation I find most frustrating is not the senior who made a complicated financial mistake. It is the senior who set up their social security, withholding carefully and responsibly at enrollment, did exactly what they were advised to do, and has been overpaying the federal government every single month for 5 or 10 years simply because no one ever told them the W4V can be updated. These are responsible people losing thousands of dollars annually to a form they forgot they filed. That is what I am here to fix today. Here is what we are covering. First, how Social Security taxation actually works, including the provisional income calculation. Second, the 4 withholding rate options on the W4V and how to choose the right one. Third, exactly how to complete and submit the updated form. Then 2 bonus points for seniors with more complex income situations. Point 1. How Social Security taxation actually works. The most widespread misconception is binary thinking. People believe either that Social Security is always taxable or that it is never taxable. Neither is correct. Whether your benefit is subject to federal income tax depends entirely on a calculation the IRS calls provisional income, and the result is different for every single beneficiary. Here is how provisional income is calculated. Take your adjusted gross income from all sources other than Social Security, including wages, pension income, interest, dividends, and IRA withdrawals. Add any tax-exempt interest you received. Then add 50% of your annual Social Security benefit. That total is your provisional income. If your provisional income is below $25,000 as a single filer, 0% of your Social Security is taxable. None of it. If it falls between $25,000 and $34,000, up to 50% may be taxable. Above $34,000, up to 85% may be taxable. For married couples filing jointly, the thresholds are $32,000 for the 0% tier and $44,000 for the transition to the 85% tier. The word up to matters significantly. The taxable percentage does not jump immediately to the maximum the moment income crosses a threshold. It increases gradually. The precise taxable amount is calculated using IRS Publication 915, Worksheet 1. For the lower income senior whose primary income is Social Security with a small pension or minimal investment income, your provisional income may place you in the 0% tier or the lower portion of the 50% tier. If your W4V is withholding at 10 or 12%, you may be withholding against a liability that is a fraction of what is being collected, or against no liability at all. That April refund is not a bonus. It is your own money held without interest. For the comfortable retiree with pension income, IRA withdrawals, and investment earnings in addition to Social Security, some portion of your benefit almost certainly falls into the taxable range. The question is not whether to withhold, but whether the current rate accurately reflects your actual liability, given your current income, and the new deductions now available to seniors. The provisional income calculation also changes every year as your income changes. A W4V set at enrollment and never updated is a static instruction applied to a dynamic financial reality. That mismatch accumulates into a larger overpayment with every passing year. Your action right now: calculate your provisional income using last year's tax return. Your adjusted gross income is on line 11 of Form 1040. Add tax-exempt interest from line 2 of Schedule B. Add 50% of your annual Social Security benefit from Box 5 of your SSA-1099. Compare that total to the thresholds for your filing status. If your provisional income places you in the 0% tier or the lower portion of the 50% tier, your withholding is almost certainly too high. Move to point 2. Point 2, the 4 W4V withholding options and how to choose correctly. Most seniors with a W4V on file believe they are locked into the rate they selected at enrollment. They are not. The W4V can be updated at any time, takes effect within 30 to 60 days of submission, and can be changed as many times as needed. Many seniors also believe their only options are to withhold or not withhold. In reality, the W4V offers 4 specific rates, and choosing correctly requires understanding what each one accomplishes. The 4 available federal withholding rates are 7%, 10%, 12%, and 22%. These percentages are applied to your gross monthly Social Security benefit, not to the taxable portion. If you selected 10% and your gross monthly benefit is $1,800, the SSA withholds $180 every month regardless of whether your actual tax liability on that benefit is $180, $90, or $0. The correct withholding rate is whichever option most closely matches your actual annual federal tax liability on Social Security divided by 12, expressed as a percentage of your gross monthly benefit. For seniors in the 0% provisional income tier, the correct election is 0 withholding. Any withholding at all, whether 7, 10, 12, or 22%, is sending money to the IRS against a liability that does not exist. At $1,500 monthly in benefits with 10% withholding, you are sending $1,800 per year to the government on a tax liability of 0. That $1,800 would grow in your own account if the withholding were simply eliminated. For the retiree in the 50 or 85% taxable tier, the goal is not elimination, but calibration. Compare your total estimated federal tax liability for the year against the total amount currently being withheld from all sources, including Social Security, pension, and IRA distributions. If total withholding exceeds estimated liability, reduce your Social Security withholding rate. The 7% option is the appropriate starting point for most seniors already receiving withholding from other income sources. One important caution: reducing Social Security withholding to 0 when you have a genuine tax liability creates an obligation to pay that liability another way. For seniors with no other withholding source, eliminating Social Security withholding without establishing quarterly estimated tax payments can result in an underpayment penalty. The IRS charges this penalty when total payments fall below 90% of your current year liability or 100% of your prior year liability, whichever is smaller. Confirm your total payments will meet this threshold before eliminating Social Security withholding entirely. Your action right now: estimate your total federal tax liability for the current year using your prior return as a baseline adjusted for any income changes and the new Senior Bonus Deduction. Compare that figure to your total withholding from all sources. If withholding substantially exceeds liability, identify the W4V rate that would bring them into alignment. That is the rate you will use on the updated form. Point 3. How to complete and submit the updated W4V. Most seniors assume updating a government form requires a visit to a Social Security field office, a long wait, and a complicated process. Updating the W4V requires none of those things. The form is one page with 7 lines. It can be completed in under 10 minutes, downloaded from the IRS website at no cost, and mailed directly to your local Social Security Administration office without an appointment or in-person visit. The W4V is available at irs.gov by searching W4V in the search bar. The form asks for your name, address, Social Security number, claim number from your benefit statement, and your chosen withholding rate from the 4 available options. You sign and date the form. That is the complete process. The completed form is mailed to the Social Security Administration office serving your area, not to the IRS. The SSA processes the update, and the new rate takes effect within 30 to 60 days. A confirmation letter will arrive showing the updated withholding amount. If your state taxes Social Security benefits, currently 12 states do so, including Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont, among others. A separate state withholding form may also be required. Contact your state revenue department for details. For the senior eliminating withholding entirely, on line 6, check the box indicating you do not want federal income tax withheld. Leave the percentage boxes blank. Sign, date, and mail to your local SSA office. Your next deposit after processing will reflect your full gross benefit with no federal deduction. For the retiree adjusting to a lower rate, check the box for your chosen percentage on line 6. The new rate replaces the old one completely, with no need to separately cancel the previous instruction. Sign, date, and mail. If uncertain which rate to select, 7% is the most conservative starting point and can be adjusted again after your next annual filing confirms actual liability. One important limitation: the W4V operates prospectively only. It does not retroactively adjust withholding already collected. Prior overpayments are recovered through the annual tax filing process by claiming a refund on Form 1040. The updated W4V stops future overpayments. Prior ones come back through your next return. Your action right now. Go to irs.gov, search W4V, and download the current form. Complete lines 1 through 6 with your name, address, social security number, claim number, and chosen rate. Sign and date line 7. Mail to the SSA. Office, serving your zip code using the office locator at ssa.gov. Set a reminder to check your deposit statement 30 to 60 days later to confirm the change was applied. Bonus point 1. Coordinating Social Security withholding with pension and IRA withholding. The W4V governs only Social Security withholding. Pension withholding is governed by Form W4P, filed with your pension administrator. IRA distribution withholding is governed by Form W4R, filed with your IRA custodian. All three sources contribute to your total annual withholding and the decision about Social Security. Withholding cannot be made in isolation from the others. Calculate your total estimated tax liability first, then subtract withholding already coming from your pension and planned IRA distributions. The remainder is what Social Security withholding needs to cover. Divide that remainder by 12 and express it as a percentage of your gross monthly benefit. Round to the nearest available W4V option. That is your correct rate. For many retirees with both pension and Social Security income, pension withholding alone covers the entire tax liability. In those cases, the correct Social Security withholding rate is 0, and eliminating it creates no underpayment risk because the pension withholding is handling everything. Confirm this by comparing total estimated liability against total estimated pension withholding before making the change. Bonus point 2, the Senior Bonus Deduction, and how it changes everything for 2025 and beyond. The Senior Bonus Deduction introduced for tax years 2025 through 2028 changes the withholding calculation for every qualifying senior, and the qualification criteria are broad enough to include the majority of seniors watching this video. The deduction adds $6,000 to the standard deduction for single filers over 65 and $12,000 for married couples where both spouses are over 65. That additional deduction reduces taxable income directly, which reduces the tax liability that withholding needs to cover. A married couple previously carrying a $4,200 annual federal tax liability may find the $12,000 senior bonus deduction reduces that liability to $1,800 or less. Their existing withholdings now more than double what is necessary. The rate that was correct in 2024 may be substantially too high for 2025 and every year that follows. Recalculate your estimated 2025 federal tax liability, incorporating the senior bonus deduction before deciding on your updated W4V rate. Use your 2024 return as the baseline. Subtract the applicable deduction from taxable income. Recalculate the resulting tax. Compare it to your current total withholding across all sources. For most seniors, this reveals a reduction opportunity substantially larger than the W4V review alone would suggest. Here is the single most important idea from everything covered today. The W4V is not a set-it and forget-it document. It is a living instruction telling the federal government how much of your money to hold each year without interest and without automatic adjustment when your circumstances change. The rate that made sense at enrollment may be completely wrong today because your income changed, your deductions changed, or new provisions like the senior bonus deduction were added since you last reviewed it. The fix is straightforward. Calculate provisional income. Determine what portion of your Social Security is actually taxable. Calculate your total federal tax liability, accounting for all available deductions. Compare it to total withholding from all sources. If withholding exceeds liability, and for many seniors it substantially does, complete a new W4V, select the rate that closes the gap, and mail it to your SSA office. The entire process takes less than 1 hour. The financial recovery for a senior withholding at 10% against a zero or near zero liability is between $1,500 and $3,600 per year, staying in their account rather than sitting with the government until April. The government collects what it is owed efficiently and automatically. What it is not owed, it holds until you ask for it back. The W4V update is how you stop making an interest-free loan to the federal government every month with money that belongs to you. Before closing this video, do one thing. Share it with one person in your life over 65 who receives Social Security. If they have a W4V on file that has not been reviewed in the past 2 years, there is a strong chance they are overpaying every single month. One conversation and one form submission could return $1,800 to $3,600 annually to their household. On a fixed income, that is not a small amount. That is a meaningful recovery from a mistake that costs nothing to fix except the knowledge of how to do it. That is exactly what this channel is here to provide.